Welcome to this explainer on ASC 305, cash and cash equivalents. Specifically, we're diving into Part 4, foreign currency remeasurement and journal entries. So let's jump right in. Today, we're unpacking the exact month-end mechanics you need to master cash accounting under ASC 305. Honestly, if you've ever felt like the period close process for cash is just this chaotic scramble of journal entries, well, you're definitely in the right place. We're going to break down the logic behind these entries so it all makes perfect sense.
Think of this explainer as your insider's reference library for closing the books. We'll be hitting foreign currency remeasurement, routine cash operations, equivalents and restricted cash, bank reconciliation adjustments, and finally, overdrafts and petty cash. Let's get to it.
All right, Section 1, Foreign Currency Remeasurement, which is absolutely a mandatory period close compliance task.
I find that a lot of teams surprisingly miss this one, mainly because it doesn't really feel like a traditional transaction. But here's the absolutely crucial point. If your company holds cash in a foreign currency, whether that's euros, pounds, yen, you name it, you must remeasure it into your functional currency at every single period close. Let me repeat that. At every reporting date, not just at year-end. And you've got to use the closing exchange rate exactly as it stands on the balance sheet date.
So how do we actually do this? Well, it builds through a really logical four-step process. First, you identify all those foreign currency cash balances. Easy enough. Second, you apply that closing exchange rate as of the balance sheet date. Third, you compare this newly remeasured amount to whatever you previously had recorded on the books. And finally, step 4, you recognize the difference. That difference? That's your foreign exchange gain or loss.
This slide brilliantly illustrates the math in action. Let's say you hold 100,000 euros. Your original booking rate was 1.08 US dollars per euro, meaning you had $108,000 sitting on the books. But by the balance sheet date, the closing rate shifted up to 1.11. Suddenly, those exact same 100,000 euros are equivalent to 111,000 US dollars. So without us moving a single cent of that cash, we just generated a recognized $3,000 gain on the income statement. Pretty cool, right?
The cause and effect here is super simple, and it completely dictates how your journal entry is going to look. If the foreign currency strengthens against your functional currency, like the euro becoming more valuable against the dollar in our last example, bam, you record an FX gain. But if the foreign currency weakens, you record an FX loss. It's just a straight-up reflection of your purchasing power at that exact point in time.
But hey, here is a massive watch-out straight from the source material. You absolutely must add this to your period-end checklist and make sure you pull your closing rates from a documented, reliable source. Auditors are definitely going to check this. In fact, using stale rates is literally one of the most common audit findings out there. Do not let a lazy exchange rate pull drag down your clean audit, okay?
Moving right along to Section 2, Routine Cash Operations. We're talking receiving, depositing, and paying. Notice the logical flow of the accounts here. It's all about patterns. When a customer pays us, we increase undeposited funds and relieve their accounts receivable balance. Then, when that cash actually hits the bank, we clear undeposited funds right into cash at bank. And of course, paying a vendor relieves accounts payable against that bank cash. It's a perfect closed loop. Honestly, master this pattern and you've mastered the basics of cash accounting.
All right, Section 3, Equivalents and Restricted Cash. Let's look at purchases, maturities, and transfers.
Think of purchasing a cash equivalent, like say a 90-day treasury bill, as just moving money from your left pocket to your right pocket. You debit cash equivalents and credit cash at bank. Easy. But upon maturity, it's slightly different. You get your original cash back plus accreted interest. So this means you debit cash at bank for the full amount received, you credit cash equivalents for the original purchase price, and here's the kicker. You credit interest income for the difference. Now that difference we just talked about, that's your accreted interest income, and it's recognized right at maturity. It elegantly captures the growth in value over your holding period. The beauty of this is you don't have to guess the value day by day. It all trues up perfectly into income the very second the equivalent converts back to standard cash. Now, for restricted cash, like money sitting in an escrow account, the journal entry is incredibly straightforward. It's purely an asset swap. When you fund the escrow, you decrease your available bank cash with a credit and increase your restricted cash balance with a debit. And when that restriction finally lifts, you simply flip it. Debit cash at bank, credit restricted cash. Notice there's absolutely no income statement impact happening here.
And speaking of no income statement impact, you really need to keep an eye on the timing of those restrictions. As a restriction release date approaches and crosses that 12-month threshold, you have to move it from non-current to current restricted cash. Just remember, this is solely a balance sheet reclassification. It changes the geography on your balance sheet, sure, but it does absolutely nothing to your income.
Okay, Section 4, Bank Reconciliation Adjustments. It's time to true up the books.
You know, bank reconciliations are really just about recording the items the bank knew about before we did. When that bank statement finally arrives, we have to align our books with reality. For service charges the bank took out, we debit bank fees expense and credit cash at bank. For interest they graciously gave us, well, we debit cash at bank to increase it and credit interest income. They're just simple, necessary true-ups.
But then, of course, there are the not-so-fun true-ups, like non-sufficient funds or NSF checks. When a customer's check bounces, the bank just yanks that cash right out of our account. So our cash goes down, meaning we must credit cash at bank. And because the customer didn't actually pay us, they still owe us the money, right? Therefore, we debit and reinstate their accounts receivable balance. This actually brings us to another massive watch-out from the source material. You must fully reverse the original receipt by reinstating the receivable. A super common mistake here is jumping the gun and writing off that NSF amount as a bad debt expense immediately. That is just flat out incorrect at this stage. Think about it. The customer might still pay you with a valid wire transfer tomorrow. So reinstate the AR first and deal with bad debt later if they truly default.
All right, final section, Section 5, overdrafts and petty cash. We are managing the edges of cash here.
First up, overdrafts. Listen, if you overdraw a bank account, you cannot present a negative cash balance on your financial statements. Negative cash isn't an asset. It's basically a sudden loan from the bank. So to fix this for reporting, you debit cash at bank just enough to zero out that specific negative account balance, and you credit a current liability account to accurately show that you owe the bank money.
Next, let's talk about replenishing petty cash. Say your office manager spends the physical cash in the lockbox on, office supplies and some postage. To refill that lockbox, your journal entry decreases your main cash at bank with a credit and increases the specific expense accounts incurred, like supplies or postage, with debits.
So, the crucial point here is this. Notice what is not in that journal entry. You do not debit the petty cash asset account itself. You only hit the expenses. The total authorized petty cash fund balance stays completely intact on your ledger. You're literally just replacing the physical cash that was spent and recording the expenses that justified the spending in the first place.
Okay, let's wrap this whole thing up. Whether you're dealing with foreign currency remeasurement, restricted cash escrows, or just routine daily operations, mastering period close cash simply means following a consistent, systematic framework for every single transaction. It really is that systematic once you see the framework in place.
But hey, knowing the mechanics is only half the battle. As you prepare to close your books this month, I want to leave you with this thought. You know the debits and credits now, for sure, but does every single entry in your library have the bulletproof supporting documentation that an auditor will demand? An entry without evidence is honestly just a guess. Make sure your documentation is as strong as your accounting logic. Thanks so much for joining me on this explainer, and happy closing!